Hello, am I audible to all of you now?
Yes, sir.
So let's start for the topics which I have left yesterday. So yesterday we were discussing some of the current topics which were there in the news. So yesterday we are talked about the insolvency and bankruptcy code. So insolvency and bankruptcy code is created for those entities which have taken the loan but who are not able to, we can say those who are not able to, we can say repay the loan on time because of the genuine losses. So in such situation, the government, what you can say, the company can apply for insolvency, and that company can be dissolved completely, and and it may lead to what you can say, it may lead to that person may be able to what you can say take a fresh loan again, right? Yesterday we have seen that the Reserve Bank of India has again started a new scheme that is called as one-time restructuring of the assets or one-time restructuring of the loan. So restructuring of loan is means that if any lost loans or if any loans which are not able to, they are not able to take the they are not able to what you can say start their business. If they are in loss, they can again restructure the loan. They can apply for again a fresh loan. That is what is mentioned there. Then here you can see artificial avoidance of permanent establishment status, merchandise export India scheme that is explained here. Like to increase the export in India, a scheme has been started by the government. So obviously this merchandise export India scheme will be helpful for mains exam. But again, you need to know what are the schemes started by the government to export the merchandise. So government of India introduced METS through Foreign Trade Policy 2015-20. It seeks to promote export of export of notified goods manufactured implemented by the Ministry of Commerce and Trade Industry. So we know that sometimes the UPSC give a statement like this particular scheme is what you can say, this particular scheme is started by this ministry. That is what is mentioned sometimes. So that is explained here. So you can say here that the merchandise export India scheme is started by, it is started by the implemented by the Ministry of Commerce and Trade Industry. Check. So the next is here in rewards will be given under METS are payable at 2 to 5% of the product by way of duty credit script. So here you can see that by reducing the duty credit script, what will happen? There will be more export. So this scheme has been started by the government to to increase the export, and after increasing the export, there will be what you can say more foreign exchange reserve for the country, and that more foreign exchange reserve of the country will help in what you can say reducing the value or what you can say appreciating the value of the Indian rupees to the other what you can say compared to the other currencies. So the script can be transferred, used for payment of number of duties and taxes. It is tradable also. So this duty credit script question can be asked. So just mention, just to you what is the duty credit script. So this duty credit script scheme has been started by the Ministry of Trade in the Ministry of Commerce and Industry, Ministry of Commerce and Trade. And again, you can see that this duty credit scheme can be used for paying the taxes, or it can be what you can say traded, means it can be sold to other persons also. If anyone is sending, if anyone is exporting, then he can get the credit of what you can say the duty credit script. It is similar like the carbon credit script, which you have the carbon credit which you have seen in the environment. So that you need to remember here. So duty credit script. Next is the remission of duties or taxes on export product scheme. So remission means what? There will be no duties or there will be no taxes on the export. Government of India has introduced what you can say the RODTEP to replace the METS and create a fully automated route for input tax credit. So here the input tax credit will be given to the exporter. Both MES and RDTP quick to free up what you can say the capital of exporters. So that you need to remember here. So here one important term, that is duty credit script. What is duty credit script? That you need to remember for the prelims exam point of view. Now going to the next term, it is mentioned that it is same an electronic refund module will be set up to automatically refund input tax credit. The move will increase the bank credit to the exporters under the export credit insurance scheme, and exporters will receive a higher insurance cover from the banks that offer capital loans. So this scheme is specifically focused at increasing the export of India. Now, amendment to the IBC, Insolvency and Bankruptcy Code. There are some changes in the Insolvency and Bankruptcy Code. So, what is that amendment? The amendment is that earlier, because the earlier only corporate and retail borrowers were covered under the IBC. So, Insolvency and Bankruptcy Code, only the corporate companies and retail borrowers were covered under the IBC, that they can apply for insolvency and bankruptcy. Now, but recent amendment has included financial institutions also. Financial institutions like NBFCs. So even NBFCs can also apply for what you can say the insolvency and bankruptcy. We have seen in yesterday's news also, we have seen that even the NBFCs who are in loss now, they can also apply for insolvency and bankruptcy as per the IBC code. Any financial institutions having net worth of rupees 500 crore can be drawn into the IBC. DHFL, that is Divan Housing Finance Limited, has been the first financial institution which is dragged under the IBC. So we have seen that DHFL, that is Divan Housing Finance Limited, which is a housing finance company, which has been in loss in last few months. So it has applied for IBC, that is, it has applied for insolvency. This amendment has done under the section 227 and 239 of IBC. Next, off budget financing. Off budget financing means what? Yes. What is your name? I forgot your name. Zainab. You have asked me a question yesterday, right? What is interim budget and what is this? So off budget financing means what? In budget already there is an estimation that from where the government is going to finance or from where the government is going to receive the money and where the government is going to expend the money. So sometimes the government do financing of the budget. Of the budget means what? Which is not mentioned in the budget speech or which is not passed in the parliament. In such situation also the off budget can be done. So that is what is mentioned here. So this refers to the expenditure that would funded through the budget. Example, Government of India has allocated 800 food security and gives the MOP of 25 kg for procuring 10 kg. The expenditure according to 50 kilo. So here you can see that in certain situations the government gives what you can say financing which is off budget. Off budget means what? Which is not mentioned in the budget. In spite of that, the government gives such type of financing. So this is called off budget financing. That is what is mentioned here. That recently the government of India had given a finances for the procurement of the food grains for the Food Corporation of India. So this is called as off budget financing, which circumvents the parliamentary procedure. Parliamentary procedure means what? Without taking the approval of the parliament, such type of financing, such type of money is being given by the government, does not reflect the picture of fiscal deficit. CAG in its report said that off-budget financing is very, very huge. The fiscal deficit is 3.3%, but when it considered with off-budget, it has 5.5% of the GDP. So what is happening? Because of this off-budget financing, the fiscal deficit of the government may increase. That is what is mentioned here. Got it? Any doubt about the off-budget financing? So got it? Why off-budget financing is not good? Because that is our controller and auditor general of India said if this type of what you can say off-budget financing leads to high fiscal deficit. Now going to the next, peer-to-peer lending. So it is peer-to-peer lending means what? The concept of crowdfunding. An institution will set up a platform where multiple lenders as well as borrowers will be registered and it will facilitate borrowing lending. So peer-to-peer lending is a situation or is a mechanism, is a tool through which multiple lenders will come together and multiple borrowers will come together, and it will make an easy job to borrow the money as well as to invest the money. So it will not have any mediator. There will be no mediator in between between the investor as well as in the borrower. The institution providing platform also not what I can say interfere. It will not interfere. Who don't have collateral will benefit from this. This will be beneficial for those who do not have collateral for raising the money. So it will be what you can say increase the loans. It will increase the loan, and there is no cap for the lender up to 50 lakh. Borrower has a limited up to 50,000. So borrower can borrow 50,000 rupees, and the lender have a cap of what you can say 50 lakh rupees. So there is a cap in peer-to-peer lending system which has been created by the government. Fine. Any doubts about it? Yes, Bagisha. Am I audible?
No, sir. Thank you.
Am I
Yes, sir.
okay.
Yes, sir.
So ये समझ में आ गया peer to peer lending का इसमें क्या ध्यान में रखना है peer to peer lending. In peer to peer lending is actually a concept of crowdfunding where multiple borrowers will come together and multiple what is lenders will come together, and there will be no mediator between the peer to peer lending. Is directly the lender and investor will take the money. There will be no middleman here. And here, but there is a cap for such type of peer to peer lending, that is 50 lakh rupees for the lender and 50,000 rupees for the borrower. Fine. So it will be again a kind of collateral free loan. Fine. And since it is a collateral free loan, so 50,000 rupees is the cap. Clear? Any doubts?
No, sir.
Yes. Going to the next term now. Deposit insurance that we have discussed yesterday's class. Deposit insurance, we have seen that the commercial banks are supposed to take the insurance for the deposits which the people are depositing in their account. So that is which we have yesterday discussed about it. I hope all of you have read it once again. I'll go to the next temporary merchant assistant that we have discussed yesterday. Base erosion and profit shifting also we have discussed. Then country by country report about the base erosion and profit shifting is also mentioned here. Profit shifting, remember profit shifting means what? Some companies are created to shift the profit to avoid the taxes. So an international level organization is trying to what we can say reduce such type of tax evasion. Anyone remember which is that organization? That is OECD, Organization for Economic Cooperation and Development, plus G20 are planning to plug out these loopholes where the companies, multinational companies are trying to what you can say evade the taxes by profit shifting. That we have discussed yesterday's class. So question can be like, consider the following statements regarding the profit shifting and base erosion. So statement will be like, this initiative has been started by United Nations, what you can say Organization of Trade and Development, UNCTAD. So statement is correct or wrong?
Wrong.
It is wrong. Actually, it is started by OECD, right? So then again, it will say the profit shifting is a process through which the companies try to, what you can say, multinational companies are trying to evade the taxes. So again, statement can be given like, the other G20 company as well as OECD company are trying to, what you can say, plug the loopholes of the profit shifting and the base erosion. So the statement is correct. So such type of question can be framed in prelims exam. Going to the next, I have asked you to go through what is the difference between NEFT, then RTGS. I have asked you to do. So now next is UPI, Universal Payment Interference, blue economy also we have discussed in yesterday's class. Capital conservation buffer also we have discussed, where the commercial banks are supposed to keep some amount of CAR. MDR, that is merchant discount rate, we have discussed. Cross subsidization also we have discussed. Insolvency and bankruptcy code also we have discussed. Debentures also we have discussed yesterday. Debentures are issued by the private sector to raise the capital. Commercial paper are the, what you can say, the ways through which the private sector raise the money, and bonds are the tools through which the government, what you can say, raise the capital. White label HM also we have discussed yesterday's class. Angel tax. Yes, we'll discuss about the angel tax today. So angel tax, I'm expecting a question on angel tax this year. Government of India under IT Act of Section 56 can impose angel tax. So it is a tax on the initial capital of a startup which greater than its valuation amount, the extra investment will be taxed. So suppose if there is an extra investment in the startup, then the government will impose such what is the taxes on the investor, and that is what is called as angel tax, which was in the news recently. So question can be asked about it because we have seen that last year there have been a tax which has been asked like equalization tax. Question has been asked on the equalization tax. Question has been asked on the what you can say on the GST. Question has been asked on the what you can say, other types of taxes. So I'm expecting a question on the angel tax. What is the meaning of angel tax? The next is valuation, that is market value of company. The startups certified under the government of India are exempted from the angel tax. So you need to know this about it. So those startups which have been registered under the government of India as a startup companies, so they are not supposed to pay the angel tax. If the funding is up to 10 crore, net worth of the investor is 2 crore, even in this situation tax is exempted. So that is what is mentioned here. So the 10 crore, what you can say, suppose if the total funding is 10 crore and the use of only 2 crore if the company is using. So earlier the tax used to be imposed on the 8 remaining, which was an excess. Right? So the tax was imposed on the extra investment of the valuation of the company, it was there. But as per the recent what is the direction given by the government, so the startup will not be what we can say charged, or they will not be what we can say, they do not need to pay the tax. That is what is mentioned here. Any doubts about angel tax? Check. Check. Going to the next step. Now, why it is called as angel tax? Because this type of taxes acts as an angel to the startup companies. Check it. Now, next is external benchmarking, repo rate plus other costs incurred by the banks for banking loans. So, we know that whenever the banks decide about the lending rate, what should be the interest rates, it decides upon the repo rate as well as the other costs which are incurred by the banks while lending. So, Janki Raj committee recommended that banks should decide the lending rate on the external benchmarking. So can anybody give me an example of the external benchmarking? Any external benchmarking which is not internal, where the bank can refer to the other benchmarking of before the lending to the people. Any external benchmark, example of external benchmarks? Anyone knows? Yes, Bigisha, do you know the example of the external benchmark?
No, sir, I was reading it yesterday, but I don't know exactly.
ठीक है, Rupali or Sonali, examples of the external benchmark. ठीक है. He is not there today. Piyush is not there. Okay, fine. So the examples of external benchmarking is LIBOR and MIBOR. LIBOR means London, what you can say the international banking, what you can say the rate. So what happens to what should be the interest rate, or what should be the what you can say the interest rate, which should be this. Yeah, I know, Bagisha, you know it, but उसी को कहा जाता है ये आपको नहीं पता. Am I right?
Yes, sir.
So that is what is mentioned here. So like the commercial bank not only what you can say use the repo rate and the other what you can say the cost which is incurred by the commercial bank, but apart from this we should also consider the external benchmarking of the lending, because what is this London what you can say interbank lending rate, which is called as LIBOR. Actually it gives an idea to the commercial bank that how much should be the interest rate should be imposed by the commercial bank. So we can take their reference while deciding the interest rate. So that is what is recommended by the Janki Raj committee. Recommended that the bank should decide the lending rate on the external benchmarking. Currently, banks decide these lending rates on the internal benchmarking, that is cost of banks incurred on the loans on their own. So bank decides on their own about the what you can say the interest rates. External benchmarking, that is repo rate plus 10%. That is what is mentioned here. Fine. So external best example of external benchmarking is LIBOR. So there is one that all the commercial banks in the world, they have created a common association, and through that common association they decide what should be the lending rate of the what you can say the interest which should be given and which should be taken from the people. Next is called marginal cost of funds based lending rate, MCLR. So it is the minimum interest rates of the bank below which it cannot lend except in some cases allowed by RBI. So MCLR rate means what? It is the minimum interest rate on at which the commercial bank can lend. Below that minimum interest rate, the commercial bank cannot lend it, except in some cases allowed by RBI. Like for example, recently RBI has allowed to lend the commercial bank interest or low interest on the home loans. Like we know the home loans are around 6% and 7% per annum now. Why it has been allowed by RBI? Because we know that housing sector and the home sector and the real estate sector is facing a lot of liquidity crunch, a lot of what you can say the losses, and because of that what is happening that because of that the RBI has allowed the commercial bank to what you can say commercial banks to what you can say lend below that MCLR. So what is MCLR? MCLR is the minimum interest rates of the bank below which it cannot lend. So it is an it is an internal benchmark. It comprises of marginal cost of funding plus what you can say the other cost, then operational cost, then negative CRR, then what you can say the 10-year premium. That's how much 10-year premium, like how much 4 years or 5 years or 10 years, how much the years is that. On that basis also the MCLR is decided by the commercial bank. Okay? So just give me a minute, we'll continue. Okay, I'm audible to all of you now? Fine. So next important there is called as foreign exchange swap. So recently we have seen that Indian government had a swapping with the US for dollar swapping we have done. So what is that foreign exchange swap that is mentioned here? RBI has initiated this step to fuse liquidity into the banking system. RBI will purchase $5 billion from banks, and after 3 years, banks can repurchase it from RBI. So what is happening that many a bank which is having what you can say the foreign exchange reserve, that will be what you can say the foreign exchange swap can be done. So RBI has initiated this step to fuse liquidity into the banking system, and RBI will purchase $5 billion from the banks, and after 3 years banks can repurchase it from the RBI. So you need to remember here is that whenever RBI goes for foreign exchange swapping, it leads to increase in the liquidity in the market. So it will increase foreign exchange reserve of RBI, because whenever the Reserve Bank of India is having what you can say less number of what you can say the foreign exchange reserve, or if the foreign exchange reserve is reduced, then RBI can go for such type of foreign exchange what you can say the foreign swaps, foreign what you can say the swaps. Next is external commercial borrowing. What is external commercial borrowing? If the borrowing is from the private sector and not by the government, then it is called as external commercial borrowing. If it is from the government sector, then it is called as the government borrowing or a sovereign borrowing. But if the borrowing is from the private sector, then it is called as external commercial borrowing. So it is the financial instrument used to borrow money from the foreign sources of financing to invest in the commercial outlet of what you can say the commercial activities of domestic country, borrowing money from non-resident lenders and investing it in the commercial activities of India. So that is what is mentioned here. Then going to the next, FRP, fair and remunerative prices. decided by the Cabinet Committee on the Economic Affairs, while the MSP is decided by the CACP, that is Cabinet Committee on Agricultural Cost and Pricing. So it is, although FRP is recommended by CACP, but it is decided by the Cabinet Committee on Economic Affairs. It is the price which government decides from any commodity, example sugarcane, but not paid by the government to farmers. It is paid by the mill owner. So what is the difference between FRP and MSP is that in MSP, the government procure the food grain or the agricultural produce from the farmers and government give it to the farmers. Within FRP, it is the mill owners of the sugar cane, they give it to the government. So here the government do not give money to the people, but the mill owners will give it to them. In MSP, the government gives that MSP price to the farmer. So that is what is the difference between the FRP and MSP. So MSP is a minimum support price. It is decided by the government and paid by the Food Corporation of India to farmers on its procurement. So that you need to remember here. So what is the difference between FRP and MSP? That is the basic difference. Got it? Any doubts about MRP and FRP? And I hope all of you know what is MSP and what is FRP. MSP means minimum support price, which the government is supposed to give to the food grain farmers, and it is decided on the basis of the input cost of the farmer, that what is the input cost of that particular crop. So that if the farmer should have a minimum what you can say the income for that particular crop. So if that price is not what you can say available in the market, then the government has to buy that food grain at the MSP. So whatever the procurement is made by the government through Food Corporation of India, it has to be done at the minimum support price, right? So there is something called procurement price also. The procurement price can be more than MSP, but it cannot be less than MSP. Got it? So procurement price is a price at which the government is procuring it from the farmers. But procurement price can be higher than MSP. It cannot be less than MSP. So can anybody tell me in which situation the procurement price will be higher than MSP? You are getting my question? In which situation the MSP can be higher than the minimum support price? Yes, Gitanjali, what do you think? In which situation the MSP can be higher than the minimum support price?
Inflation, sir.
Inflation. So what leads to inflation? Means what will happen if
Lesser production and higher demand.
sorry?
Less production and higher demand.
Okay. Yes, Gitanjali.
Yes, sir. I thought the same, that when there will be the higher demand and there will be the inflation, so they will pay more price to the farmers.
Who government will pay more for price to the farmer?
Then MSP.
Okay, one
More
thing,
price.
when the government buys from the farmers, like in which situation the government should procure the agricultural produce from the farmers at MSP?
When will be higher production?
Yeah, so when there is a higher production and when the private sector is not buying that produce at that particular price. So when the market price of that agricultural produce is lower than the MSP, then the government buys it at MSP. Am I right? Am I right?
Yes, sir.
When the market price
Yes, sir.
of agricultural produce is less than the minimum support price, then the government has to buy it at MSP. That is, the MSP. But suppose if the market price is higher than MSP, suppose in the market, so MSP, for example, suppose the MSP for wheat is 3,200 rupees per quintal. That is MSP decided. But suppose if the market price of the wheat, that in the market, due to the higher demand, as you say, that higher demand because what you consider supply is less, money is more. And because of that, what is happening? Suppose there is higher demand, and if the market price is what you can say 3,000 rupees per quintal. So the farmer will sell it to the government or farmer will sell it to the in the market?
In the market.
In the market. So in such situation, we know that the government also needed to maintain a buffer stock to use it during the contingency situation. So in such situation, the government has to buy the food grains from the farmers at 3,000 rupees, which is a market price, which is higher than the MSP. So here the procurement price will be higher than the MSP. So the procurement price can be higher than the MSP when the market price is higher than the MSP. And if the market price is below the MSP, then obviously the government has to buy it at the MSP value, that is the minimum support price value.
Yes, sir. Yes.
Clear? Rupali? समझ में आ रहा है?
Yes, sir.
Yes, sir.
Chandrasekhar? Clear?
Yes, sir. Yes, sir.
Zainab?
Yes, sir.
ठीक है, चलिए गीतान, sorry, Bagisha? Is it clear to you?
Yes, sir.
Okay, ठीक है, चलिए going to the next important point. Sorry, bilateral netting. First, we will discuss the bilateral netting. Okay, what is the meaning of bilateral? Two-way. Bilateral means two-way, right? So it is a way to release capital. It allows two parties involved in a swap agreement to net off their swap and positions. Such bilateral netting, which is the global standard, will help reduce the amount of capital you need to set aside for such vertical transaction. Indian financial contracts laws do not permit bilateral netting. They do not allow multilateral netting, where parties can offset claims against each other through the central counterparty. But anyways, since it is not allowed by the government, so you don't need to worry about it. I don't think question can be asked about it, but just remember, bilateral netting is a way through which the companies can swap their capital, which is not allowed in India. Some countries may have allowed, but it is not allowed in India. Going to the Women Livelihood Bond, a bond which has been issued by the SIDBI, that you need to know. The question can be asked about it in the prelims. It is a type of outcome-based financing. It is a social impact bond. SIDBI is aiming to raise 300 crore and finance microfinance institutions. So microfinance institution, through which we know that maximum microfinance institution is catering the service for the women in India, which will give loans to the women with low interest. SIDBI is cooperated by the World Bank and United Nations Women. So that you need to check it out. So this particular bond, that is Women Livelihood Bond, has been given or issued by the SIDBI with a collaboration with World Bank as well as United Nations Women Organization. Fine. The next is social impact bond, generating investment in social sector. Outcome donor donates any institution working in a social, the social field, depending upon its achievement. For this, institution generates capital through bonds and repay them with increase after the donation, the got. So question can be asked in the prelims exam about this particular bond. Next is dividend distribution tax, which was in the news. So the tax on company before the dividend paid to the shareholders. So that is what is mentioned here. So the company has to pay a tax to the government before it pays the dividend to the shareholders. Company has to keep aside certain amount of profit before dividing it into the dividends of the shareholders for paying tax is called as dividend distribution tax. So this tax reduces the amount of the dividend paid to the shareholders. That you need to know about it. The next is alternative investment fund, that is real estate, takes the sector. So in real estate sector, an alternative investment fund has been created by the government. Initiative for stressed real estate sector, which has a genuine, genuine issue. Bailout for viable projects which has positive net worth and registered with RERA. All of you must know what is RERA, that is the Real Estate Regulation Authority. So those real estate firms which have been registered with the this particular RERA, they will be given a alternative investment fund it will have multiplier effect on the economy. So it will have a multiplier effect. What is multiplier effect? That we have already discussed. Fine. So 1 minute is left. So we will end here. Next session we will discuss about the remaining topics. So just wait for the meeting.